What got you here won't take you any further. And who the heck wants to be at a standstill for the next 12 months? Over the next 3 episodes, we're giving you insider access to the Inflection Business Coaching Program. Normally, this content would only be available through our paid course, but we wanted to share 3 of our favorite coaching calls with you to give you more insight into what we talk about, how we run the program, and how our coaching calls are structured. And in case you missed it, we're doing an end of financial year offer in the next couple of weeks. So visit the link in our show notes for direct access. Also, did you know you can pay for business coaching through your business? Danil, our registered chartered accountant, has confirmed it. So, if you're ready to take back control of your business, your career, and just get some balance back into your life, then join us on the 2nd of July for a whole new program. Visit the link in our show notes and join our free community for access. In this second session, Danil is running you through the financial impact of scaling your business. From key things that business owners fail at to how much it actually costs to grow your business and why data is the answer to everything.
Thanks for jumping on. Today, more or less, I'll be focusing on some of the financial sides, of scaling and growing your business. What does that mean? What does it look like? Sort of run through things bit by bit. I'm obviously a fiend for cash flow. So obviously the first component is cash flow is still king, especially when you're growing. I think scaling often requires funds and some type of, buffer to be able to operate, to continuously reinvest back into your business. And I think it always does come back down to cash flow and how well is it managed? How do you have it available? And a lot of the things that we need to do in order to scale require some type of upfront investment. So whether it's hiring staff, whether it's increasing our inventory, whether it's investing in systems, whether it's acquiring competition. So in all of these scenarios, the expense comes before the revenue, meaning that it's going to cost you before you can actually feel or benefit from the growth. So then that puts some pretty severe pressure on cash flow. So we've run through, how to input the cash flows, how to use the cash flow to sort of build out a bit of a finance function for your business. But this is now using, like a cash flow forecasting model to pre-plan your growth as well on top of that. So there's multiple uses that we use it here for. So if you're already doing that, great. If you want to grow at a very fast rate, you need some type of, metric or forecast to help you, understand what the expenses or the increased expenses are going to be over the next, call it 12 months. So in most scenarios, 3 months is, the theoretical, emergency fund that everyone recommends you to do. But based on my experience, I think having a runway of about 5 or 6 months is probably going to be the most, appropriate, especially if it's a fast scale. So if it's something that you're doing within, 12 or 24 month basis and your business is growing at a rate of, 50 to 100% year on year, then you probably want a bigger runway because you're going to be incurring lots and lots and lots of expenses a lot of the time before revenue is generally factored into it. The next component is, digging a little bit deeper into your actual financials. It's rather than looking at a spreadsheet and looking at the results over a time limit. When I say time limit, it's our budgets, projections, financials, that tracks your business over a period of time. It doesn't track whether your goods or service is always profitable. It doesn't track how many units you're producing. So there's more to understanding your numbers than just looking at a period of time. So when you are growing quick and you're constantly chasing revenue, we do need to be careful of the associated expenses that are coming up with it, and understanding of, if I was to grow my revenue by X, Y, Z, how does that affect my bottom line? Am I just getting revenue for the sake of it? Am I losing money as I'm growing? These are, big conversations that need to be had, because there's no point in growing your business if you're going to go backwards from a profit standpoint, realistically. So we actually see this with so many startups. The focus is, market share to chase revenue. And for some businesses that works, especially if your exit strategy is to sell to a degree to someone large. But for most businesses, it's not an effective long-term strategy to grow your business. So we need to understand how we make money off each unit. So, going back off a bit of a definition for unit economics, it's about understanding what it costs you to sell one unit, whether it's a product or a service, and how much money you make on it. So for example, for a cafe, you need to know what it costs you to sell one cup of coffee. For a construction business, you need to know what your margins are on each job, each small job, large job, any project. For a software company, you need to know what it costs you to acquire a user and to serve a user. And for professional services, you need to know where your labor and your operating expenses ratios are. You need to understand how your resources are being used to generate your revenue. The goal here is to understand how each unit makes you profitable, right? That will then help you understand how much profit you can make, how much revenue you can generate, and I guess how much of everything you need to do to hit your targets. So I run a very, very simple example. And this example will differ from, yes, every business. So the reason it's generic, because you need to break it down for yourself. There's no, I guess, secret formula to this. The way I like to do it is I keep it really, really simple with my clients. I like to reverse engineer the goal or the target scenario. And I'll use an example where in order to achieve X, and I'm going to use $10,000 as our, call it, net profit before tax per month. Let's say that is our profit target for the month. We then need to go back and understand what are our operating expenses? How much do we pay in operating expenses? Add that back to your 10 grand. Add back your labor component. Add back your direct costs. And that will give you a rough target revenue figure. And for the sake of this calculation, it's going to be $20,000 a month. So now we need to actually understand, where does that $20,000 a month in revenue come from? How many coffees do we need to sell? How many projects need to get billed? How many sales need to get converted? How many consultations do we need to do and get invoiced? So that should then start actually creating unit KPIs for you. So you can add that to your scorecard or to, your sales metrics, but you're starting to actually understand how you make money off each unit. Now, listen, that was an overly simplified example. There are scenarios here that you just can't do it. As in, you're not pricing well enough. There's multiple reasons why, I guess, a calculation like this might not even be favorable for you. And that's probably all the more reason to actually go ahead and start thinking about it, right? Because you need to understand or ask yourself or your team or your management, do you actually have the resources to deliver the unit? So for example, if you're a professional service business and I use 30 consultations as the example, if you only have time to do 20, well, then there's an issue. There's a disparity between your targets and your resources. So now it's a conversation, well, how do I increase my resources to deliver the unit numbers? Well, in order to increase resources, there's going to be an increase in costs. So now we need to go back and reverse engineer that again. We need to increase our costs to then increase the consultations, because our consultation numbers with an increased cost might go to 35 now. So what you're doing now is you're asking yourself questions of, how do I fix this equation? Especially if it's not lining up for you. For some businesses, you might turn around and say, sweet, this is super easy. I've been doing this for the last 6 months. I know how to generate it. Well, for you, great. And keep working with that. Keep using your KPIs to continue to grow from there. But in my experience, 7 out of 10 businesses wouldn't even be able to answer a lot of these questions for me. And a lot of the businesses that struggle with profit essentially don't even think about stuff like this. So it's so important to understand the unit economics of what are you actually doing, because that profit or the ideal profit is then used as like a bit of like a reinvestment fund. So you're making these profits, you're going through, and then you're spending them on other things. So your financials might not be showing a profit. The financials might not be looking that great, and your cash flow might not be fantastic. But if you understand how you're reaching that point, it'll help you continue to scale. Because if we were just to look at, for example, your cash flow, and if it's a business that does make a $10,000 net profit, but ends up spending $6,000, $7,000, $8,000, $9,000, $11,000, $12,000 a month on reinvestment, whether it's software development, whether it's other R&D projects, whether it's overstaffing, whether it's, crazy marketing strategies that are going to, increase revenue by X amount. you need to understand how these things are going to get paid for as well. So I think it always comes back down to a bit of like a unit economic perspective. And that is so much easier to track from a KPI perspective than more or less anything else in your business. If you know how many units to deliver, you'll be able to more or less track whether you're doing well or unwell, whether strategies are successful, unsuccessful. So this is one of those back and forth scenarios that you should be doing, going, how do I hit my targets? There's a lot of things you probably haven't factored in. It's like, am I discounting to win new customers? And if you are you discounting too heavily? Would it be more profitable to get less customers at a higher price? Essentially doing less for more. Costs are going to increase or decrease with volume. So let's say if your volume increases and you might be able to get discounts, or for example, a service-based business, your costs are going to actually go up exponentially because you more or less need a staff member to deliver, and staff members come in packages. You probably need a full-timer. And if you're not winning the work to get 40 consultations, well, then we need to start increasing the volume of work. And it's a constantly moving, formula, a constant moving problem that you should be, looking at as a business owner. Because realistically, and something that isn't really thought of a lot of the time, is understanding the impact of volume and how you need to plan for that as well. So if this is something that you struggle with, or you're not sure if you've done this, or you're not sure how to do this, I'm going to give you a bit of an action step. I want you to go back through your profit and loss. Pick a period of time. If you want to, start easy, use a week. If you want to, go back and get some more information, use a month. So break down your P&L into units and how it all applies. Whether it's going through your sales and understanding, well, how did my sales get generated? How many units did I spin out over this period of time? Go through what were the costs associated with them? When did I pay them? How did they apply? And then go through and actually track where everything sits, how it sits, and whether your, good or service is profitable or not. Are your costs outweighing, the revenue coming from it? Because that might sometimes, explain the, overs or unders in profit. It's the biggest issue we see all the time. Sometimes pricing just isn't up to scratch. You're using a pricing model that worked for you as a sole trader, but now you're a larger organization, better systems, better resources, better staffing. You need to be factoring in your, increased costs with your pricing. So it might even be a very, very easy solution. It's like, well, what if I don't need to increase my units? All I need to do is increase the revenue per unit. That, again, changes the whole equation for you as well. So give it a crack. If you don't really already know your unit economics, it's probably worthwhile to go back through your historical data and understand it. I do want to, double down that this isn't like some quick task you should outsource as well. Could you, use resources available to you, for example, accountants, bookkeepers, whatnot? Absolutely. But this is something you as a business owner need to understand. And the service is probably one of the harder ones, especially how you price, because service industry that's on like a fixed price versus, variable project pricing, very, very different. So I think we need to probably sit down and understand, okay, well, how do we track this unit? Is it an hourly allocation? Is it a project? And understand how you price, your work first. So for example, Colin, a lot of the work you do, is it fixed project price, or is it based on like an hourly sort of labor component? How do you generally price some of your projects? Fixed price, right? So what you need to do is work off whether it's a unit or fixed price. So for example, because obviously jobs increase and decrease based on value. So even if you use a day as a unit, so there's probably most jobs at least take a day, right? There's no jobs that are sort of like 2-3 hours or anything like that. They're mostly one day here. So if that's the case, I would use the day as the unit. So when a job comes through and it's, goes over 2 or 3 days, you just multiply that by 2 or 3. So you want a unit that is completely flexible and transparent. You're better off having more units sort of to track than having, half a unit or a fraction of the unit. It's easier to, multiply it So for a service-based industry, so for example, for us, we also have a fixed price model, and our one is based around, the pricing and the lodgement. So it's always reduced down. So for example, a larger group that has, 4 entities, that's 4 BASs, 4 tax returns, um, 4 meetings, 4 summaries that need to get created, 4 sets of management accounts, but essentially one client. So we can't treat that as one unit. The unit's got to be 4 times BASs, so 12 BASs throughout the year. 4 company returns, 4 financials, 4 management reports, 4 tax planning sessions. So the unit is actually not one, it's, 24 or whatever it's going to turn out to be. And that's a very similar approach you should take, especially for some of your bigger jobs. It's rather than seeing it as one job, you should see it as multiple units and applying the same, unit breakdowns just on a multiple of what's going on. So that's the sort of, as to the action point, using historical data is the key here. Go back, understand what has happened to get you into this position so that you can go through and understand how to hit targets and goals. Because that's going to be the biggest piece of evidence that you have. It's not a competitor. It's not a Google search. It's not, a set of slides somewhere. It's your own historical data that will help you make the decisions to continuously improve moving forward. So this is something that I personally sort of struggled with as well as a growing business, is that systems and processes need to be constantly reviewed and updated as well. So as a small team, you can probably have certain processes that are quick, they're a bit manual. There's sometimes a bit of a reliance on people, it's in their head or whatnot. But as a business grows with volume, those cracks, they start to open up pretty quick. And inefficient systems can really, really, affect your unit economics and your bottom line, meaning that you're paying for too many resources and not getting enough revenue for it. So, because at the end of the day, when we're growing, we don't just want to be doing more revenue. We need to be able to deliver more. We need to be able to manage more and support more without sort of more or less breaking down. And a lot of that does come with a, direct cost as well, whether it's, labor hours of managers, going through improving processes, systems, whether it's contractors coming in to help out with, different software points, whether it's, additional training that the whole, company requires. All of that takes time and it takes money. So these are the things that we go back and go, okay, cool, I need to improve my systems. I need to spend a little bit of money to reinvest back in, and go back up to to the cash flow component and factor in how long it's going to take, factor in how much it's going to cost and how many resources it's going to use up or take away, because we are also factoring in the opportunity costs here. So if you've got staff that are constantly in training, upgrading software, or working on non-billable work, we almost need to remove that as well and say that, well, we don't have those resources to complete X amount of units. So, and beyond that, it doesn't mean that your processes now are crap. It doesn't mean that at all. It just means that your processes are there for the business that you have now. So our experience of where you came in with, or our processes are fantastic, even at volume, it's going to be great, blah, blah. Volume comes in and you sort of fall apart and you're like, holy crap, our systems are not good enough for this amount of volume. This is far more than we predicted, and cannot be managed off this. So then it becomes a bit of a skill of, okay, well, we need to pivot here. What do we need to do? How do we fix it? Where's the shortfall? How do we understand it? And I think the businesses that do, best in these scenarios are the ones that are able to identify and pivot first. And the quicker you can identify it, the lower the cost to improve it will be, because you don't have the inefficiency of these, underperforming systems and processes. And a lot of the times, very, very hard to predict, because we go into these, decisions of scale or decisions of growth, thinking that our systems and processes are up to scratch, not up to scratch, but are able to cater for the increase. It's only until you get to that point in time whether you actually get the answer of, yes, this can cater for it, or no, we can't cater for it. And again, this will dive into a little bit deeper, I guess, when we do the full scaling model. This is a bit less financial, but super, I guess, important to understand. Going off everything we sort of just went through, it's knowing the cost of growth is super important. So I think I'll happily use sort of Glenn's example there is, running a service type business where it's, for example, two blokes in a van. To increase resources, you're going to have to buy the van, salaries of two blokes, any tools, any, fit outs to the vans that you need to do, whether it's getting, trays, lockups or whatnot. You can budget through what that's going to cost. So if in order to hit targets, we need to do this. This is the impact financially we're going to have. Again, it's going back and I guess understanding how it fits into that cash flow that you're building out or that forecast that you're building out and going, okay, I might need 50 or 60 grand to get this over the line, or I might need 100 grand to get this over the line. Because whether we like it or not, growth costs money. Hiring a team member, it's the salary, it's the super, it's the onboarding time, even the downtime that I haven't even factored in, where they're sort of learning how to work with everyone. Launching new product, whether it's research and development, marketing, production, split testing, it costs money. Expanding into new markets, whether it's, logistics, compliance, sales meetings, but other meetings that are involved with, different suppliers and potential competitors and whatnot. And then what we were just referring to is that improving that systems and processes. It is a direct cost in time. There's a direct cost in software. There's a direct cost in training. So every time that we're building, I guess, to grow, we need to estimate the cost, but more importantly, the timeline. I think for anyone that's grown a business and knows, okay, I know how much it's going to cost, but the timeline is so important here because unless you draw it out, you're not really sure when you're going to start seeing benefits of certain investments or how long it takes to particularly roll out. So what we've been doing is physically drawing it out on a literal timeline and going, okay, week 1, this needs to be completed. Week 2, this needs to be completed. Week 3, this needs to be completed. Then attach a cost to each component saying, this is what needs to get done over a period of time. And we hear it all the time. I hear business trying to go, I hired this person to do X, Y, Z. They said it was going to take 2 days, ended up taking 2 weeks. A lot of the time it comes back down to an understanding component of what's being done as well and having the ability to monitor and, I guess, keep people and your contractors accountable, because just like your staff, contractors are there to, I guess, help you out, or whether it's a service provider, there needs to be a clear understanding of what they're doing. And there needs to be very, very clear monitoring of what's happening as well. Because if something was to take 2 days and takes 2 weeks, there's a very, very big cost differential here. So unless you've sort of factored that in, that could have a fairly large, I guess, impact to performance, to bottom line, to your profits. It could really, really hurt a business. So I think knowing the cost of growth and understanding the timing of growth is super important, because we can't expect all these great things and big things to happen without some type of time delay. Nothing good happens overnight, and in the best way possible, meaning that, when you're working towards something and there's, a lot of effort going into it, like going to the gym, you're not going to see results in 24 hours. It's going to take consistency. It's going to take time. And it's the same as growing a business. So you need to be able to timeline certain things. Beyond that as well, sometimes you don't want, different growth costs to come in at once if you don't have the cash flow to maintain it. If you do have the cash flow to maintain it, then great, run it all at once, get that ball rolling really, really quickly. But if you don't, and you are running tight and you're using your working capital to more or less fund the growth as well, that's when planning and timelines are super, super important. And that sort of, I guess, takes us to our next slide, which is the funding your growth. So I think anyone that's grown their business has used some type of funding, whether it's personal funding where you've put your own money in and use the equity component to build up the business, incur the costs. But more so than less, I guess, if that's the right terminology for it, a lot of these fast growing businesses have finance or have debt against them, whether it's business loans, whether it's overdrafts, whether it's equipment financing, asset financing, invoice financing, or even sort of equity fundraising in terms of going out and getting other people to invest in your business, giving them a share and whatnot. There's no right or wrong here. What I guess factors you need to consider is what fits you and your business. Sometimes there's not enough volume, or the business isn't large enough to give away equity and the target isn't big enough. So there's very little, benefit of asking someone for 10 grand for 10% or whatnot. That's not really going to get you that far. And that's where debt is probably more an appropriate factor. Or, are you trying to take over a large market share and you need, millions of dollars to come through? Then equity funding might be a great option for you because there should be enough volume to split between everyone. Invoice financing, if you plan it out right. I know the Action Boys, when they first started, they used this method and they used it really, really successfully. Equipment and asset finance, I think more or less every business uses something along those lines. And also overdrafts. I think overdrafts are a really, really good way or line of credits, or some type of finance that some type of lender or bank provides to you. The ability to have money now, especially in a business, is super, super important. And avoiding debt sometimes to business isn't always the best option. It is for some. I definitely know a couple of clients that I have that I would tell them to absolutely stay away from debt. I've seen their spending habits, shocking. But for other businesses that know how they're going to reinvest their funds, they know how they're going to, spend the money, they understand the cost of growth, then all debt does is speed up your growth process. So knowing what you need or what your business needs, and then being able to go and achieve it is so powerful. So when you actually run through, you've got your cash flow, your forecasts, you've got your unit economics, how many units you need to sell. You've run through, what it's going to cost you to grow, the timelines behind it. Then there's no reason that debt doesn't help you. I've seen debt take businesses from $1 million in revenue to $10 million in revenue in, 2 or 3 years. And that's increasing profits as well. Because all it's done is fast track the growth. When you take the right steps, it's very, very, unlikely that your debt becomes a risk. Going back to a very age-old conversation of, is debt bad or good? Well, I think if, a line of credit can take your business from, 1 to 10, 1 to 5, 1 to 3 in a short period of time, doesn't actually impact profits, it's going to be very hard to treat that as bad debt, because it is a bit of like a working capital. If you don't have the equity to do it, debt is the next best option. So understanding what your business needs is step one. Step two is knowing what options you have to generate, funding to get the business to grow. And again, this isn't just to grow your business. This is to grow your business exponentially. Sometimes if you're just growing, it's probably enough just to use your working capital. But if you want to, double the size of your business in a short period of time, I think debt or some type of equity. So if you've got funding outside of it, if you've got savings or whatnot, you're going to need those funds to more or less get ahead. So know what your options are, know what each of those options costs you as well. Because each of those, especially the debt side of things, have a direct cost attributed to them. And if you're getting outside investors, the cost is a percentage of your business. So know what the costs are for all your options and weigh up which one suits you best. And lastly, at scale, you need to understand your data. You don't need to process your data. You don't need to know how, the data comes from, but you need to understand it. And you need to more or less get comfortable with your data, because that's what's going to help you make the right decisions moving forward. You need to understand what products and services are the most profitable, what products and services generate the most revenue, what keeps your customers happy, what's your customer acquisition cost, is cash flow an issue, a debtor days issue, there's break-even points. So it's actually proven that data-driven businesses scale faster, they're more efficient, less likely to have wastage, and they're able to pivot far quicker because they can generally spot, major problems before they occur. And that's the key here with pivoting, because you're going to come into, issues, you're going to have problems, you're going to have hurdles that you need to overcome at growth. But the quicker you can identify them, the faster you can come up with a solution for them, and the faster you have access to money to fix them, then the quicker you're going to be able to grow and to continuously grow, because business is purely hurdles through and through. And I think everyone here on this call can probably agree with that comment, is that regardless of what size the business is, there's going to be hurdles. So the more you understand your data, the more you get comfortable with your data. I think that's sort of one of the last sessions is it doesn't even need to be perfect. And, you know, I love this quote, something that sort of sticks with me. Don't let perfection get in the way of progress. Sometimes having some data to be able to track it is better than going, I don't know, it's not perfect, I'm not going to look at it, or it's too hard, someone's got to show me it. Get data. The more you look at it, the better you'll get it. The quicker you get it, the faster you'll be able to refine it and get it to a position where you need it to work for you. So, big tip. Heaps of people, I guess, on the inflection community and who we've spoken to saying, you know, I don't understand financials, I don't understand this. Work towards it. Break it down in layman's. Use, you know, iPhone math. I'm a big fan of iPhone math. You know, I spit numbers into there all the time. Use percentages, ratios, estimates, just to get a really good understanding of what's happening. I think it's a really, really effective tool. And my final little slide here is growing your business should not break your business. The point of scaling, the point of growing really fast, the point of doing everything is to do it in a sustainable, controlled, and profitable way. When I say profitable, it means unit economic profits. You know, you can be incurring losses if you've got large capital reinvestments. You can be incurring losses if you're buying, you know, large pieces of equipment, piece of depreciation coming through. And there's ways that you should be able to track, I guess, your performance that isn't directly related to a set of financials. And unit economics is that way. So when you're scaling and you understand, I guess, all the key points that I've sort of highlighted above, the business shouldn't break because you've got a, I guess, solution for at each point of how to handle that problem. So if you have the right systems, the tools, the advice, the people, and you can hit the accelerator, it should be just all steam ahead. When the hurdle comes, I guess, dive into it, throw some money at it if you have to make it go away. But there's ways you can counteract all of that. I think the biggest, I guess, downfall I think growing businesses have is that they don't really have a plan. Is that they go in, so I'm just going to grow. And they don't know how, they don't know why, they don't know, I guess, what they need to do to grow. If you follow some of these sort of really, really simple steps, it will be enough to, I guess, double, triple your business. So if the business is struggling because you're growing, you need to go back and understand how and why. Thank you for joining me. I hope everyone has a great day and the rest of the week. Thanks, everyone.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.